In 2017, Bitconnect appeared as a shining star in the crypto world, promising massive, stable returns. The system was widely advertised as a once-in-a-lifetime opportunity to become rich. Promises of 10–12% monthly profits drew millions into the frenzy. These bold claims painted Bitconnect as the ideal crypto investment platform, where you could simply invest and watch your wealth grow. But behind the glitzy exterior was a Ponzi scheme, one that would lead to a financial nightmare for everyone involved. Don't forget to like and subscribe to Financial Story so you won't miss the next shocking financial stories. With Bitconnect, investors were quickly drawn in by the promise of massive, guaranteed returns. Newcomers, as well as large organizations, rushed to get involved, believing that crypto was the fastest way to become a millionaire. The enticing offers made people blind to the underlying risks. As Bitconnect grew, it became the talk of the crypto world, with everyone talking about it like it was a sure bet for financial success. The system felt like a golden opportunity, and soon everyone wanted to be part of it. Bitconnect was marketed as a platform that could change your life, and the growth seemed unstoppable. As Bitconnect gained momentum, more and more people got involved, driven by the massive returns that were being promised. The illusion of stable, guaranteed profits began to spread. But what the investors didn't know was that everything was fake. There was no actual product, just a scheme to take money from new investors and pay off the older ones. The Ponzi scheme worked for a while, but as participation slowed and fewer new people were joining, the system began to crumble. The truth was that Bitconnect was not a legitimate business. It was simply a financial pyramid designed to collapse as soon as the flow of new money stopped. In the beginning, Bitconnect wasn't built by cryptocurrency moguls or seasoned investors. It was created by ordinary individuals with a keen understanding of human nature and a desire to capitalize on the growing crypto market. Their success wasn't due to innovative technology or financial insight. It was their ability to exploit the market's greed and the desire for easy wealth. At its core, Bitconnect promised something almost too good to be true: stable, guaranteed returns in the chaotic world of cryptocurrency. The allure of 10% returns every month without needing to understand the complexities of the market was simply irresistible. For the average person, Bitconnect was presented as the solution to financial freedom. The entry barriers were low, making it accessible to anyone, even those with little to no financial knowledge. Investors didn't need to have expertise in cryptocurrencies or understand blockchain technology. All they had to do was lend their money to Bitconnect and wait for the profits to roll in. For many, this was a golden ticket, an easy way to get involved in the booming world of crypto without much effort or risk. As Bitconnect grew, its appeal spread like wildfire. What began as a small community of early adopters soon turned into a global phenomenon, with influencers, social media posts, and even prominent crypto enthusiasts endorsing it. Its creators effectively used social proof, the idea that if everyone else is doing it, it must be legitimate. The platform marketed itself as an exclusive opportunity, pushing the idea that anyone who was not investing would be missing out on the future of finance. The language surrounding Bitconnect made it feel like a movement rather than just an investment opportunity. The community was built around the belief that participants were part of something bigger, a revolution in personal finance. This sense of belonging made investors feel validated. They weren't just making money, they were part of a global network of forward thinkers who were seizing a once-in-a-lifetime opportunity. The more people that joined, the more Bitcoins and Bitconnect tokens flowed into the platform, creating a sense of growth and success. But what many failed to realize was that Bitconnect was not a legitimate investment. The platform didn't trade crypto or create any new value. It relied entirely on a continuous flow of new participants to pay off existing investors. The system wasn't backed by tangible assets. There were no real trades or business activities supporting the value of Bitconnect tokens. It was an illusion designed to keep the money flowing in a never-ending cycle. The ease of entry and the quick rewards made it hard for anyone to question the legitimacy of the system. Investors trusted it because they had seen others succeed, people just like them. They believed in the idea that they could achieve financial success without needing to work hard or understand the intricacies of the market. This is what made Bitconnect so dangerous. It preyed on people's dreams and vulnerabilities, making them feel secure and validated as they blindly followed the crowd. As Bitconnect continued to grow, the hype surrounding it intensified. It seemed like everyone, from friends and family to people in your professional network, was talking about it. People began joining not out of curiosity, but out of fear of missing out. FOMO. The thought of turning a small investment into a substantial sum within a matter of months was irresistible. Bitconnect's smooth marketing, professional-looking websites, and flashy endorsements from well-known figures made it look legitimate, but underneath it all, there were cracks forming. In the early days, many investors didn't take the time to question how Bitconnect could guarantee such high returns, or why the platform required so much money to be invested up front. The fact that Bitconnect offered an opportunity where people could lend their money and receive monthly profits without ever needing to know about the technology behind it seemed almost too good to be true. But Bitconnect played into this ignorance and exploited the fundamental flaw in human psychology: greed. People wanted easy money. They didn't care about the underlying mechanics. They wanted instant wealth. The promise of stability, the assurance that their investment would grow steadily, reinforced the belief that Bitconnect was legitimate. As more people joined, the word-of-mouth marketing amplified, and soon it became the talk of the crypto community. The growth was exponential, creating an illusion of safety, but also setting the stage for what was about to come. Despite the rapid expansion, there were early signs of trouble. Some savvy investors began to notice the discrepancies in the returns, but the sheer scale of success Bitconnect had achieved made it difficult to question. The profits were real. They were just paid using new investments rather than through actual trading or value creation. Still, this wasn't obvious to most people. For the average investor, it was hard to connect the dots between the constant stream of new money flowing in and the promised high returns. Bitconnect offered multiple levels of investment, enticing investors to increase their contributions in exchange for greater returns. This strategy only added fuel to the fire, as people became more desperate to earn more and more. The more they invested, the more they were encouraged to recruit others, building the pyramid structure of the Ponzi scheme. In these early days, Bitconnect also attracted people with a crypto background, further solidifying the platform's credibility. They believed in the power of blockchain and decentralized finance, and Bitconnect used these concepts to manipulate their trust. These investors, who had already made significant returns from cryptocurrency, saw Bitconnect as another opportunity to cash in. But for most, it was a vicious cycle of greed. The more money you put in, the more you were promised in return, and the more people you recruited, the higher your profit would become. The snowball effect took over, and soon, Bitconnect became an unstoppable force. Its web of investors grew by the day, and the money that kept pouring in was used to pay the early participants. The idea of high returns with minimal risk sounded too good to be true, and yet so many bought into it. As Bitconnect reached its peak, the cracks became harder to ignore. The system's reliance on new investors became more evident, but by this point the stakes were too high. The number of referrals and new users had skyrocketed, and the platform was running at full speed. The more people that joined, the more confidence and enthusiasm grew. Yet, deep down, some investors started to question the sustainability of the platform. The more experienced crypto investors began seeing the red flags: no actual product, no legitimate business activity behind the growing profits, and the reliance on new investments to pay off older ones. However, their voices were drowned out by the blinding greed that had taken over the majority of Bitconnect's community. The constant stream of positive stories, coupled with fake reports of profits, only reinforced the illusion. Bitconnect had created a self-sustaining loop of optimism that was nearly impossible to break. In the end, the loyalty to Bitconnect and the sense of community among investors kept them from acknowledging the truth. Many refused to see the obvious red flags, clinging to the belief that they were part of something monumental. In the final months before the collapse, Bitconnect went into overdrive, promising even greater returns to those who would commit more. It was the perfect storm. The platform was growing too fast, and the numbers on the screen were too alluring. The core flaw was hidden under layers of greed, optimism, and willful ignorance. When the end of Bitconnect came, it was sudden and catastrophic. By the time the platform collapsed, it had reached a global scale, with millions of participants around the world, from small-time investors to major institutional investors. The entire crypto community was in shock, as the truth about Bitconnect became undeniable. It was nothing more than a Ponzi scheme. The first signs of collapse began when the platform's native currency, Bitconnect tokens, started losing value dramatically. As the tokens plummeted, it became clear that Bitconnect's ecosystem was not sustainable. The once promising profits that investors had earned were wiped out, and as the value of Bitconnect's assets disappeared, investors began to panic. The media, which had previously been full of glowing stories about Bitconnect's growth, now turned on the platform, exposing the fraud to the world. The collapse didn't just happen in a single day. Bitconnect's downfall was gradual but devastating. The platform's owners initially tried to downplay the situation, using their social media accounts to assure investors that everything was fine, but it was already too late. As the platform began to restrict withdrawals, investors rushed to pull out their funds, but the money wasn't there. The doors were closed, and the digital wallets that once held millions were now empty. As the truth unfolded, the real scope of the damage became apparent. People from all walks of life had fallen victim to the scheme. Some investors had put their entire life savings into Bitconnect, believing that they were making a smart move for their financial future. Others had borrowed money to invest, hoping to earn quick profits to pay off debts or fulfill other financial obligations. But now, their lives were in turmoil. The economic devastation was compounded by the psychological toll the collapse took on individuals. Families were torn apart as relationships began to fray under the weight of financial loss. Long-term friendships were destroyed as people who had once been in the same Bitconnect boat began to turn on one another, pointing fingers and blaming each other for getting involved. It wasn't just the financial damage. Bitconnect had destroyed trust. The personal and social consequences were severe. In addition to the loss of financial stability, Bitconnect's collapse tarnished the reputation of the entire cryptocurrency market. Many people who had invested in crypto for years, including some well-respected institutions and individuals, now found themselves disillusioned and skeptical. The public perception of crypto as a whole became tainted, with many seeing it as an unreliable, speculative market. The idea of decentralized finance, which had once been touted as revolutionary, was now under intense scrutiny. The aftermath of Bitconnect's collapse wasn't just a financial disaster, it was a social and cultural catastrophe. Legal actions were taken against the creators and promoters of Bitconnect, but by that point the damage had already been done. Most of the money was gone, and many of those who had believed in the platform never got any of their funds back. Some of the promoters went into hiding, while others were arrested or charged with fraud, but they were long gone before any restitution could be made. The legal proceedings were slow, and for many, they felt like too little, too late. Crypto, as a whole, had lost its sheen. What was once considered the future of finance now felt like a high-risk gamble. Investors were wary of new crypto projects, and the regulatory environment became much stricter. The story of Bitconnect was told and retold, becoming a cautionary tale for anyone who considered investing in crypto without understanding the risks. For many, Bitconnect would forever be synonymous with financial failure, fraud, and blind trust. The final cost of the Bitconnect collapse was far-reaching. People lost not only their money, but also their trust in the financial system, and in many cases, their confidence in crypto. Those who had been victims were left to pick up the pieces of their broken lives and to try to rebuild their financial futures, if they could. The collapse of Bitconnect serves as a stark reminder of the dangers lurking in the world of investment, especially in high-risk markets like cryptocurrency. The promise of quick riches often blinds people to the real risks involved. In the case of Bitconnect, the allure of easy money led millions down a dangerous path, where the value of their investments wasn't backed by anything substantial or real. The lesson here is simple, but it's often ignored. If something sounds too good to be true, it probably is. This saying applies to all investments, but it's particularly true for unregulated markets like crypto. Bitconnect thrived because of the lack of understanding of what it really was, a Ponzi scheme dressed up as a revolutionary new financial product. For every successful story that circulated, there were dozens of others that were silenced or ignored. The platforms that make exaggerated promises often exploit investors' hopes and emotions, and Bitconnect was no exception. While Bitconnect was a spectacular failure, its story is not unique in its sea. Many have fallen victim to similar schemes, chasing after false promises of huge returns without understanding the risks or the systems behind the investments. Whether it's high-yield investment programs, HYIPs, fake ICOs, or Ponzi schemes, these systems are designed to exploit human greed and lack of knowledge. The truth is, no legitimate financial institution promises such high returns with no risk, and if they do, that should be your first red flag. Bitconnect's downfall didn't happen overnight. It was the result of years of deceptive marketing, unquestioned trust, and a growing community that didn't ask the right questions. If there's one lesson we can take from this, it's that blind trust, no matter how tempting the returns, can lead to devastating consequences. The case of Bitconnect is a call to investors everywhere to always perform due diligence, question anything that seems too good to be true, and to never invest more than they can afford to lose. In the world of high-risk investments, that rule can be a lifeline. The final takeaway from the Bitconnect debacle is a call to action for the future. Crypto and decentralized finance, DeFi, hold immense potential, but they also carry significant risk, and these risks are magnified by lack of regulation. As we move forward, we must demand accountability from those who create and promote such platforms. Investors, especially in new and emerging markets like crypto, need to be educated about the risks and to look beyond the promises of quick, high returns. They must ask themselves, what's the underlying value? What's the real risk? Moreover, the regulatory environment for cryptocurrency must evolve to prevent such massive scams in the future. As individuals, we must be cautious and skeptical of any opportunity that promises too much for too little. Just like Bitconnect, it could be a house of cards built on the dreams and savings of ordinary people. Investors must learn to stay grounded, keep their emotions in check, and understand that there are no shortcuts to financial success, just hard work, knowledge, and patience. Thank you for watching. If you found this story eye-opening, please like, share, and subscribe to Financial Story so you won't miss the next shocking chapter in the world of money, fraud, and history. The collapse of Bitconnect may have shattered trust, but it also provided a necessary wake-up call for investors and regulators alike. It's time to invest wisely, cautiously, and with a thorough understanding of what's truly at stake.